Hello and welcome to Unlock Your Life. I'm your host, Jennings Smith. Guys, I've got a guest in the studio today, Mr. Chris Skinner out of Knoxville, Tennessee. Chris is a longtime member of the Deal Room, my coaching program. He's been doing some big things. He has done cost segregation. He's trained a lot of insurance agencies. He is closed a 72 unit in Panama. He owns some single family rentals. He's working on another big deal in Florida. And he is becoming really focused on capital raising, having a lot of success in that. I wanted to have him on the show to just bring his knowledge in those fields to us, to share with you guys what it takes and what it looks like to transition into multifamily, to get some traction, get some success. So Chris, welcome to the show, man. Thank you for being on here.
Thanks for having me, Jennings. Appreciate it.
So who is Chris Skinner? Tell us a little bit about yourself. What is your story, man?
Well, thanks for asking. I appreciate that. So for the last 30 years that I've been in sales and dealing with a lot of clients across the country, I was an employee working for other people, doing the 9 to 5, doing the rut. And I'd worked for some very large companies that were based out of the Los Angeles basin in Southern California for, many years out there. Worked for some large manufacturing facilities on things that I was doing for selling products, wholesaling to large companies across the nation. And fast forwarding into time, in 2001, Mother's Day, right around that time frame, I actually lost my mother. My mother passed away, and that was very hard for me. And just a few months later from that, everyone knows what happened. September 11th happened. And I lost my job literally about a month and a half after that happened because the businesses started to decline. People couldn't travel anywhere. People were afraid to go anywhere. And so I lost my job and I didn't know what I was going to do. So I basically grassrooted myself and started my own company out of the my garage, out of my home, where I had a small desk and a computer and a phone. And I saw the writings on the wall that I was going to lose my job after that happened. And I had a lot of accounts that had good relationships. I built great relationships with my clients. I always did the right thing by them. I didn't want to just know, just here's the item and then sell it to somebody. I wanted to know how that stuff was made. So I was always very thorough with my clients. I didn't just sell a widget. I knew how the widget was made. And so because of those relationships built and the integrity and honesty of working with those clients, I basically just started saying, you know what, I've got one of my clients that I was selling to wholesale. I literally called him and said, look, I've lost my job. I got to take care of my family. Would you be willing to sell those cartridges that I'm selling to you at $1 over cost? And he said, I would absolutely do that for you to help you. I'm really sorry to hear what happened. So I did that. And then within the first 6 months, I had a client that was buying a large amount of product for me. And within those first 6 months, he actually didn't pay his bill. So I thought I was going to lose my business. So I just stuck through it and kept going.
Wow. So, when the chips are down, it kind of reveals character. And so, you kind of went even the more risk path and said, okay, I'm not going to find another job. I'm going to strike it out on my own. And that was that your first like entrepreneurial kind of venture in 2000, I guess that was 1 or 2002?
Yes, that was my first time being a business owner and starting from scratch and trying to figure out life. And I actually had a brand new wife, and I also had 2 children at the time. And they were babies, and I had to figure out what I was going to do and take care of them. The fortunate thing is that within the 25 years that I've now been a business owner, I've been able to work from home. I've been able to bring my wife home, and she didn't have to work, and I was able to support my family. Now, was it with peaks and valleys? Of course, absolutely. I had multiple things that transpired through times, and there was times where I felt like I was going to be homeless at times, but I always pushed forward. The one thing that I realized from all of this, Jennings, is that I have an entrepreneurial spirit. I just could not work for the man or work for other people. It was hard for me to do that because I felt like I was making other people wealthy and not taking care of my family, making them happy with what I can produce for them rather than producing for someone else.
Yeah, I mean, once you kind of get that taste of freedom, even though there's long hours and more pressure, uh, I feel the same way. It's like I worked a job for a couple of years, then started my construction company, and it was like this has got to work because I'm unemployable now. I don't want to listen to anybody else. Like I want the ball. I want to be in charge. I want to be the master of my destiny, even though there are going to be some valleys. At least I'll get the advantage of the peaks. So I get that totally. So how did you start to transition into the world of real estate where you are now? So you were selling what, ink cartridges back then, and how did that evolve?
So the good question, I'll wrap it up by saying that I started out with selling printer ribbons.
Okay.
Take it all the way back to that, and then the HP LaserJet 1 and LaserJet 2. And I saw the very first prototype of the HP LaserJet 2 jumbo cartridge that was being manufactured out of Hong Kong, which was a clear plastic mold of that where they extended the hopper, made it larger. And then now if you ever buy supplies in your for your printers today, you have a low yield and a high yield. I came from that. I started with all that. And I know the person who actually was responsible for making that all happen. So yes, I was basically helping people with printer ribbons and then also toner cartridges. But then moving into 2009, I had to go into managed print. So I started doing also managed print services. I had a copier business. I was actually a dealer for Xerox, did repairs and such. But to answer your question about real estate, so in 2007, because of the income that was finally starting to move up, we started to gain about 7 school districts that was producing quite a bit. And I also had the County of Los Angeles as a client where we had large quantities of product going to them. And as I was growing into that field, I said, okay, I want to start buying single family homes and renting them out. And in 2007, when I bought my first rental, and then I bought another house, they both went into foreclosure because of the 2008 and 9 crash. So I lost both of those homes. And I just I lost interest in even being a homeowner. So I started renting for like 10 more years.
Yeah. That was, your timing wasn't great on getting into real estate, or maybe it was because that was a tough spot. Okay, so you dipped your toe in the water, got badly burned, and said this isn't for me for the next decade. So now we're up to 2017. Now what?
Well, it was 2005, 6 is where I had my first house. Then I got my second house in 07. But it just during that time frame, I started renting. But it was actually in 2015 when I got so in 2007, to go back to that, I actually got my health and life insurance license. So I was trying to help people then also transition into generational wealth. So I had that mindset. So I read the book, Rich Dad, Poor Dad. And there were some other authors that I was reading pertaining to generational wealth through life insurance, because life insurance can actually help you do that. And there's a lot of people that are buying a lot of cars and boats and toys and homes. And they had all these houses that had a tremendous amount of equity in their home, and they weren't doing anything but buying stuff they really didn't need. I mean, they had too much. It was just, it was overkill. So when I started to learn that particular part of the financial side of things, when that crash happened, nobody wanted to talk to me about it. So I went dormant. In 2015, I was reintroduced into a wellness program that can actually help employers save an average of $500 per employee on their FICA taxes, while at the same time offering medical services. It was a wellness program for their employees, and it would give them benefits as well. And so I got involved in that, and I started with the IMO that was based out of Austin, Texas. And that president of that company was also, with him being a business owner, he used to be the senior vice president of Madison National Life, which is a $2 billion insurance company, who had started his own company probably about now going on 11 years ago. And he owned it for 9 years and sold it to AmeriLife 2 years ago. And he's still the president of that today. But he owns a tremendous amount of real estate. And so because of that, we started offering other services like cost segregation, research and development tax credits, energy 45L credits for builders who are building 500,000 homes, where they can get anywhere from $1,500 to $2,000 in credit for each house that they were making energy efficient.
Gotcha. Okay, so you're working with this company, boss is buying a lot of real estate. He's starting to offer some of these cost seg. And it seems like cost seg started to open your eyes to the power of this is how the wealthiest are preserving wealth, and this is how they're saving on taxes, and this is how they're growing it. Can you dig into that further?
Certainly. So over the years, I was helping people with both research and development tax credits. One of that started in 1981 by Ronald Reagan. That was called ERTA, which is the Economic Recovery Tax Act. And it was new, basically any company that was building something new to the world, it was to keep businesses from leaving the United States soil and going abroad to other countries to keep everything land-based here in the United States. So it allowed people to be able to receive credits for those that they were, if they were improving upon new and developing new things to the world. And so there was a tremendous amount of benefits and credits for those large companies to be able to do that. The cost seg part of that with real estate, it was also at that time, if I'm not mistaken, during that time frame, bonus depreciation was only at 50%. And it wasn't even widely talked about. A lot of this stuff was never educated to anyone that was a taxpayer that had property. A lot of people that didn't even know about this stuff. So when you fast forward to the time that we're in now, all the education that we have regarding real estate, whether it's multifamily or storage units or RV parks, whatever the space that we're kind of working in now, there wasn't a lot of education on this. And there's still today, believe it or not, there are 700 federal and state incentives available to business owners they don't even know exist. So what's happening is that there was an article in 2019 in the CPA journal. And in that journal, the CPAs across the country basically were realizing that 73% of their clients had 1 foot out the door because all they do was tax preparation.
Mm-hmm.
There are 3-4 thick volumes of the tax code, millions of words in the tax code, and one CPA is not going to know all the rules and regulations in there as to what they can actually take advantage of. So even people that owned real estate, whether it was an auto dealership, whether it was a medical office, if it was a triple net strip mall, single family homes that you could even do that on, apartment buildings that we do. A lot of people didn't know about cost segregation. It's now a commodity today, but even just 10 years ago, it still wasn't really widely known, even though that today it's 40 years old.
Yeah.
However, with that being said, you've got the Trumps of the world, Bezos, Elon Musk, even Ray H. Kroc, the owner of McDonald's. It was never about the hamburgers. It was about the real estate. So when I started going through my journey on that, I helped a lot of businesses recover so much money in either a taxable refund or a depreciation, a tax deduction off of their taxable income. And I saw this happening to, hundreds of clients. So I'm watching them make millions of dollars and not paying federal income tax. And it finally took me buying new homes again in 2022 and 2023. And I said, you know what, I've got to be a customer of something that I've been selling. And so when I did that, not only did I not have to pay almost $200,000 in taxes that year because of the income that I made from something else that I'll discuss in just a moment. The wonderful thing about that is that I had my aha moment, because not only did I have a tax credit or a deduction from cost segregation, I got a tax refund instead of paying $200,000.
Yeah.
So when you see the power of what that can do for someone, it's huge.
It is. I remember learning about cost seg maybe 6 years ago, and I had no clue prior what it was. And I'm making good money in 19 and 20 and 21 and 22 and even in 23. And I'm literally paying no taxes because I had bought so much real estate and had done these cost segs, and I'm selling stuff, and I have, just some things rolling in, making good money, making more money than I never made. And I was paying more taxes when I ran my little construction company, making $150,000 than I was making multiple times that much, because of these tax strategies. And it was just like, wow, this is amazing. And I see how those incentives really can grease the wheels of the economy, because last year I was like, okay, I need to buy real estate because I'm going to have a tax liability. And I got hammered in 24 because I didn't buy enough real estate. And so, and now I'm looking at my next deal for 26, proactively planning, like, okay, I'm going to do this flex warehouse space, and that's going to be a tax hammer. But if I can offset that with another long-term real estate deal, then, and it makes me a buyer again because I have a tax problem. And so, yeah, I've seen firsthand the power of those strategies. And conversely, the accountants and the CP, it's like they never told me about this stuff. I mean, I'm telling them, hey, I want to do this. I want to do this. I mean, in 24, my accountant said, oh, you're going to owe like $300,000 in taxes. I'm like, dude, no, I'm not. Like, we're figuring this out. And we end up getting it down to like one something. And it was still too much, but, it was better than 300,000. So
let me ask you a question based off of what you just said. Have you ever heard of Simple Fee? Or Fee Simple, excuse me, the other way around. Sorry, Fee Simple.
Like on title?
No. I know what you're talking about on title. You see Fee Simple all the time on documents through CoStar, and you're like, okay, this is a Fee Simple product. But there's actually Fee Simple credits, deductions, another deduction. So for those that don't have an actual piece of real estate, if you're facing tax consequences and you're going to have a big bill to pay, there is a PPM, an operating agreement, and a subscription agreement. It's buying land. It's all on the up and up. We have letters of opinion from some of the largest tax firms in the country, where you put, for every dollar you put in, you get $5 in deductions. And so if somebody puts in $100,000 in, they're getting $500,000 in deduction. And it's basically going into a land trust. Now you don't get the property, you're not getting anything from that, but it's actually another tax credit that most people don't talk about. There's even the Augusta rule. I don't know if you're familiar with the Augusta rule. So we provide also, outside of me being in real estate, we provide tax strategists that actually can help my clients in the real estate space that are very wealthy, that don't know about this, where they're going to spend $20,000, $30,000 a year doing tax work, but on average save $120,000 a year.
I did meet with some consultants that talked to me about something. It was like investing in solar projects, and you would get credits, and it wasn't 5-1 though, or I might have done it. But now on the fee simple land, do you ever recoup your $100,000 investment, or is it kind of like that's just so that you can get the credit?
It's so you can have the offset, because you're going to put that in there. And so instead of paying $100,000 into something, you're going to end up not having to pay half of that, which is, so if you owe $200,000, so would you rather pay Uncle Sam $200,000 or $100,000 to get $100,000 off?
Right. Yeah.
Even though for every dollar you put in is $5 in credit, because of someone's effective tax rate and their state taxes and things like that, it's about 40%, and you can only go to 30% of the AGI. So again, this is very complex, and I don't want to give any legal or tax advice, but we have a team of CPAs, EAs, and tax attorney that come from the top 5 national accountancy firms: Deloitte, Ernst & Young, Moss Adams, PricewaterhouseCoopers, KPMG, to name a few. But we also have a tax attorney that is actually going to be taking on these clients on a quarterly basis, helping them strategize so that they never have to pay taxes again, utilizing these benefits and taking advantage of everything that they legally can possibly do.
And that's the issue with I think the political viewpoint of like, well, we just need to raise taxes on the top people. Well, they're the ones with all the resources. They're the ones with the accountants. They're the ones with the loopholes. They're the ones that know how to avoid this stuff. And it ends up the middle class and the lower classes end up paying more typically. I mean, I read something, it's like the top 1% of New Yorkers pay like 50% of the tax base. And if you make it too burdensome and they leave, like New York is screwed. I mean, they're going to lose half their tax base if the top 1% decide, you know what, I'm going to move to Miami because it's more favorable for me there. And I want to get political, but it's just like this thought that politicians are going to be able to outsmart the best minds in the country on how to save and protect their money. It's just, I don't think it's going to happen.
Yeah. So this is why I transitioned into this. So to go back to what you asked me about why I got into the multifamily real estate, because I think that's what you were asking me. So in 2023, and it was in the summertime, and because of my education, and we were finally starting to come out of the employee retention tax credits, that's another one that I did for my clients. So in 2020, when the pandemic happened, I saved about 500 clients over $300 million that went back into their pockets, that prevented them from being able to, so they didn't have to shut their doors. Because when I was living in California, in the Temecula area where I lived, I watched 350 businesses close permanently forever. With that being said, having done that just allowed me to be able to see what was going on. And I was watching a podcast of a Black woman. Her name is, her call sign is Moneyista. And she was basically talking about cost segregation and the laws behind it. She was an auditor for the IRS for 13 years. She's a real estate professional. She deals with multifamily, single family homes. And she actually did an interview with Grant Cardone. And she was talking about this on this podcast. She wasn't on the interview with Grant, but she was mentioning it, that when he bought his jet in 2021 for $57 million, she told him, put it into service for 2 hours and you will be able to write off 100% of that jet. And that's exactly what he did. So even somebody who's a billionaire didn't even know the power behind bonus depreciation and what you can do, because he also was facing some tax liabilities that he didn't want to have to pay. And so he's trying to figure that all out. So when I listened to her talk about that, I said, I'd been seeing this guy in my feeds for months, and I really wanted to know who this guy was and what he was all about. So I watched a documentary called The Undercover Billionaire show. And it was, I didn't watch the show. I watched an 8-hour documentary that was behind the scenes of that show, where he was dumped in Pueblo, Colorado, and had to build $1 million company within 90 days. And that was right during the pandemic. So he got sick with COVID, had to go home. They were going to shut the show down. And he goes, no way, I'm coming back. 3 months later, he went back, and he didn't turn it into $1 million with not having anything in his pocket. He couldn't tell anybody who he was. He shaved his head. Sometimes he had even makeup on and some plastic stuff on his face so that he wasn't recognized, and thick glasses, and big scruffy face, and just had to kind of change his persona on who he was. But he built a $5.5 million company. So when I saw that, that's when I jumped into multifamily real estate with both feet. Now, mind you, when you jump into these types of groups, it allows you to actually start to network, because Grant does this from an intentional standpoint of being able to network. If you want to do multifamily real estate, the teamwork makes the dream work, and your network is your net worth. So if you don't have that, you have nothing. If you don't know what to do, you have to figure it out on your own. It could take 10 years, 15 years to learn it on your own. But the speed at which you can learn this is based on everything that we're doing. And thanks to you guys in the deal room and being able to learn from you and from Yaden and just all the other people within the deal room, I've learned a tremendous amount from many. It's not just from one. So, you never can learn from just one person. There's many different points of views, and it's always good to get feedback from as many people as you can in this space.
Yeah, I think it was maybe 6 or 7 years ago, I read the 10X rule, or he published that book, the 10X rule. And I wouldn't read it. I would listen to it, but I would run every morning. I'm trying to get in shape. I'm trying to turn, like, not turn my life around, but same pressures. Like, I've got a wife, I've got a couple kids. I'm seeing expenses are going to keep growing, and what I have built is really not going to work long term. It's just dawning on me that I can't keep working 60 hours a week. And so I'm trying to get in shape, and I'm listening to this book over and over, and he put the fear of God in me. He really did, that book, because he tells the truth of, like, it's going to take 10x the effort that you think it's going to be 10 times as hard as you think it's going to be, and you're going to need 10 times the resources that you think you need, and you got to get going right now. And I needed that, and that was like, okay, I can do this, and started really pouring into educating myself on real estate and multifamily, and how to. And this was before he was even doing multifamily. Like, he was just doing the sales coaching and all that stuff. Like, he hadn't even started buying real estate, I don't think. But yeah, that book, I can really specifically point to it as it woke me up to, you are behind, and it's going to take longer than you think. It's going to be harder than you think. It's going to take more money than you think. And everything in the future is only going to get more expensive, and you better get going. And he's right. There's no sugarcoating it. So yeah, I like Cardone, and I went to GrowthCon out in Vegas back in, I think it was 2016. So I must have listened to that book a lot longer than 6 or 7 years ago. I listened to it a while back, but anyhow, okay. So you join, you're listening to Cardone. You're starting to learn about multifamily, and in your bio you talk about, okay, 72 units in Panama, 600 units LP. Like, how did those deals start to evolve?
So, being a part of Grant, there's some motive behind that. He is giving extreme value when you're going through his course material and attending the events and coming to his workshops, or if you go to the Bring Your Deal event, or if you're going to a real estate summit. The education and the information that I've learned from him, and this also goes for the deal room too, because there's so much information that I have learned and that I've been able to adapt to very, very quickly. The speed of the information that I've received, I literally told Grant while I was sitting in the event at BYD, which is where there was 140 people sitting in the room that are pitching their deals for those 2 days. But at the same time, you're getting a lot of education and a lot of words of wisdom and a bunch of nuggets from him in the real estate space. And I literally, when you raise your hand to ask questions, I said, I don't have a question. I just want to tell you that in the last 25 years that I've been a business owner, I have learned more in these 2 days than I have as being a business owner for 25 years. The plethora of information that man knows is incredible. Yeah, hence the reason why he's worth $6 billion in assets under management.
Yeah, you can tell he's bright, and you definitely got the work ethic going on, or at least that's how he's portrayed online. And you got to believe
that man, 67 years old, doesn't stop. He doesn't stop.
He's like Trump, he's working till 11 o'clock at night, 4 a.m. Yeah. So tell me about these deals, though.
Okay, so the 17 units in Panama City, Florida, we closed on that in June, on 5th of June in 2025. And we're now in full operation mode on that. And it was not being run properly. So we've lost some tenants on that, but we're in the process of regaining from that based off the fact that they were well below market. We tried to raise the rents a little bit, and it was starting to push people out. So instead, we wanted to make sure that we started taking care of the tenants because they weren't being taken care of. Yeah, if there was any type of service calls that needed to be done, if anything needed to be done inside the units, if there was any problems with the appliances, they were just being ignored. So now that we've got new management in there and they're on top of it, we have got them working, 24 hours around the clock, making sure that things are being done. Just getting the landscaping done, taking care of some brick issues. The street in front of the property, they came in and did some street work. The city took a while to get that done. So we are in execution mode right now. This particular property that we bought as a joint venture with about 8 people, it was about it was going for, they were actually asking 11.5. We got it for 9.5. So we got it off for $2 million. So we've got a 9.5 cap rate on this particular property, as far as where that's actually the cash on cash returns on that. But we bought this at around an 8-9 cap rate on the property itself.
That's pretty good.
Even though that we've had even though that we had some people leave and we've got some occupancy issues that we're working on, this is going to produce some great returns for us as investors. So and also operators. So quite happy with that one.
That's amazing.
Now, the 600 doors, that's being done through grant. I actually used my self-directed IRA for that. And I put my funds in there because you can't use that on your own deals. So the money that I had sitting in a 401k, and again, it's trading paper. I know nothing about what's going on in the 401k market. I don't even know where that money was even being placed by money managers or anyone that was taking care of those funds. So I turned that into self-directed funds and I gave that all to him. And I'm earning about 5 to 6% cash on cash on those. And I'm getting monthly dividend checks on that every single month. And it's non-taxed.
So this is interesting to me, and I think might be interesting to listeners. From the rumors I hear on how Grant structures deals, he is purchasing these deals and basically using investor capital as the bank, right? He's not taking a loan. And then that way, instead of paying a bank 5 or 6% interest, he's just paying that as a dividend. So it's a pretty safe bet for the investors. And then when rates improve, he'll refinance, hopefully get, who knows what he can get, 3.5%, 4%, 5%, something like that. And then give the money back to the investors. Is that right?
Yeah. So he's crowdfunding the whole entire money on his blind pool fund. So not to mention the amounts of money that's being raised, just for the sake of protecting the innocent here. But let's just call it 10 figures of money that's being raised. And when you're raising that kind of money for a project, you're doing it all through crowdfunding. And so they're being able to buy everything in cash. So when you're buying everything in cash, you have more power. He's been able to get properties at 25% below what you can get it at, sometimes even up to 50%, because he's a surety of closing because he's already got the money raised in a blind pool fund. Mm-hmm. So when the money is being dispersed, there's been no financing on it. So it's not a refinance. It's putting on brand new financing when the time is right. So when we start getting capital rate compression and the values of the property starts to go up, that's when the opportune time is to help the investors return more of their capital back to them. And it makes those investors quite happy.
And I think it's a smart way to do it if you are a guy like that who has the massive reach that he has and the reputation, right? Because we all know, you lever up a deal and you do enough of them, you're going to have a deal go wonky and sideways, and you're going to have to maybe stop distributions. And God forbid, you could even potentially have a foreclosure. Grant Cardone, he doesn't want a foreclosure on his record and that he lost investors $4 million or that he shut off distributions, et cetera. And so if he's underwriting this deal at look, it ain't much, but I can pay you 4% or 5% or 6%, but hang with me because this property is going to go up in value. We'll be able to put better debt on it and refinance out the cash or sell it at a profit, and you'll make the money on the back end. And it's in a pretty safe vehicle for now, and it's going to protect his reputation. And of course, he can make all the fees and the asset management fees and all that other stuff too. So there's some gravy in there for him because of the reach that he's built and the ability to do that. Like if I went out there and said, hey, I want to raise $10 million to buy this cash and I'm going to pay, 4%, 5% current for 5 years, it would be really difficult for me to attract capital. But somebody like him, he can do it. And it's maybe never going to have the best returns in the world, but it's going to be pretty safe and it's going to protect his reputation.
Correct. And he's also he's creating a non-taxable event. So as soon as he puts financing on there, and let's say that he was able to pay everyone their money back on that finance, the new financing that's put on it, and he paid all their money back on that, now it becomes infinite returns on it as far as cash flow is concerned. And when he gets to another disposition point of either another refinance or a sale at some point, then once these people cash out, then of course it could potentially be a taxable event. But again, this is where the power of the tax code comes in. And you can continue to keep putting that money into other deals, continue to grow your net worth, to continue to see the cash flow coming in. And cash flow is king. And I think I'm sure you well aware of that.
And so when he pitched that deal to you, what was the time frame that he proposed and what were the returns that he proposed on that?
No promises. 10 years. He says, I'm going to be sitting on this property for 10 years. Don't even think of anything like that. Just let the cash flow happen and let me worry about that. The one thing that he does very, very well is identify assets. There was a period of time when I got involved with Grant in 2023 where he hadn't bought anything for 18 months. So all those investors that were in his blind pool fund had to trust him that their money was sitting there. It was earning 3.5% on a high interest bearing account, waiting for it to be deployed. And he's like, I am not going to put myself and my investors in a bad deal, period. End of story. At the end of the day, it falls back on my shoulder if I don't buy something right. He literally just bought another property just recently that was getting ready. I think it was like coming out of auction, or was going to actually stop it from going to auction. It was before he was going to go back to the bank. That property is worth $450 billion. Let me just tell you, he paid just a little over 200. Or excuse me, 200 million, not billion.
Yeah.
450 million is what it's worth. And he paid just over 250 million or just under 250 million for it.
Wow.
And okay. It's a beautiful property that's in Florida. It's gorgeous, absolutely gorgeous.
So he's looking for some distressed stuff. Okay. And this is interesting to see the inside of another model and how he's making that work. And so he's just got this huge pile of cash. People have trusted him. He's paying out money market rates. He's essentially just passing them through. And then trying to buy, seems like he likes to buy trophy assets, real nice assets, but he's still trying to get a significant discount. But who else is in that pool? Who's in the $400 million pool? I mean, probably not a ton of competition there,
No, because he's going in and he's stealing these properties, knowing that he's got that kind of money sitting in a blind pool fund ready to pounce on it. But this particular one, he closed that property in 10 days.
And that is huge. When you are under that much pressure as a seller, you can't go through a 90-day and they're going to retrade you. And then their bank's financing is going to fall out. And, we didn't raise enough capital and on versus, look, this is not the best price, but he can close in 10 days and this nightmare can be over. That's pretty attractive.
It was going to go back to the bank. So when you're able to rob basically from someone who just ran it in the ground, didn't take care of that asset. And when you're buying you can't even build it for that amount that he paid for it. It's impossible. It would cost $600,000 a door to do that. And when you have the power of the funds that he had to pay for all that pretty much out of himself as he's starting to raise capital on the back end, and he's bringing people into that at the same prices that he paid for it. So he's not marking anything up. He's giving people value-added play here to be able to be in on a deal that he already closed on, and it's at the same rate. He's not increasing his rate to anybody.
And so your capital in the big pool is spread out over multiple assets. Is that right?
It's in two assets, and it was in a specific fund, and that fund is now closed. So when that fund is closed, then he moves on to another one.
Gotcha. Okay. So, I understand that. And that's what my hesitation with doing a fund, because I 3 or 4 years ago, I looked really heavily into it and people were like, you got to do a fund, you got to do a fund. And my hesitation with it was twofold. Like, one, am I going to be able to get investors to put their money into a blind pool fund where they say, well, we trust you, you buy whatever you want. And two, the pressure on me of, okay, I've taken this people's money, I have all this cash sitting here and I don't have a deal is it going to subconsciously kind of push me to buy or stretch or reach for a deal that I wouldn't buy otherwise? Or if I had the accountability around, look, I've got to present this specific deal to investors and get them on board with it, with the location, with the occupancy, with the business plan, everything, like those things kind of made me think, yeah, I don't really want that. But I think that going back to expectations of, look, you sit it in here and I'm going to pay you 3-4%. And if money market rates go down, I'm going to pay you less. And I don't know how long it's going to take me. And I might wait 1 year, 2 years, whatever, but you're going to have a slot and I'm going to find a banger of a deal and we're going to make money. I think if you set that expectation, it seems to work. I mean, expectations are everything versus if you're like, oh yeah, we're going to get you 15%, we're going to get you 9% cash on cash. We're going to be in and out of this deal in 2 years. And then you miss those things. Even if the deal turns out relatively well, you've missed those expectations that you set with the investors. And so they're disappointed.
Correct. So how long have you been doing this, Jennings?
I bought my first rental property about 13 years ago, a double wide trailer. And then I bought my first multifamily in 18.
Okay. So fast forward, it's now 7 years that you've done this, correct?
Mm-hmm.
Do your returns match what you've been able to project when you underwrite your deals? Have they been pretty close?
Depends on the deal. Some have vastly exceeded. Some have hit right on. Some have fallen a little short, and some have been complete failures other than return of capital. So I don't know if that answers your question, but that's the truth.
Let me ask you a question. The reason why I'm asking this is kind of important. And this is something that I'm learning as I've gone through my 2 years, and you've got another 5 years on top of me over this. But I've expanded on this part because it's going to become very important. Your credibility in this space seems to be okay. Your investors continue to keep coming back and investing with you.
Absolutely.
Am I right on that?
Yeah, absolutely.
So with your credibility, start it. You've been able to prove it. Now, I don't know if you've gotten to a disposition point or if you've sold assets and made some investors some money on those things. But again, if you're documenting everything that you're able to do in your business as far as buying the property, executing on the business plan, and paying out those investors, you'll have them come back again. And if you've already started to build that reputation, that's why I'm building my brand. That's why you've been building your brand for the last 7 years now. So when you've built out your brand and you've starting to get traction on that, take the chance. Do a blind pull fund. See how it goes for you. There's ways to actually say, look, here's my buying. This is my buy box. These are my parameters of returns, whether it's your equity multiple, cash on cash, ARR, which is a lot easier to explain than an IRR to someone.
Mm-hmm.
And if you have those types of returns that you're pretty much telling them, if I find those types of assets, would you be of interest? Would that interest you? And from a liquidity standpoint, how much money could you put into a deal like that, knowing I haven't identified the asset yet? And when you come at them that way, they absolutely say, sure, all day long. You've done right by me. Why not? So you start putting in $5, $10, $15 million into a fund, and you've got a $20 million asset, and you say, I've got $15 million. I'll stroke a check right now for $15 million. Take it or leave it. Guess what's going to happen? you just knocked off $5 million off a $20 million asset because you have now the leverage to buy it.
Mm. Yeah. Yeah.
Instead of them going out to syndication because of what happened in 21, 22, and even some in 19, 2021, 22, there's businesses are losing properties right now, and it's going back to the bank from doing syndications. And it's becoming harder and harder to raise capital through syndications. And a lot of people are moving towards even different types of funds where you don't have to have you can identify multiple assets within it. They're starting to get creative now with funds. And I would talk to an SEC attorney about that. However,
and
I would definitely look into that.
And I could see that, like, I'm embarking on my first flex development deal, and I could see the power of a fund around that, where it's like, okay, we can identify pieces of land. These are our parameters, and then not have, going into the land seller, hey, we can pay cash, and then being able to fund the construction cash and not have to worry about bank draws or building it in phases. And then, doing those as rentals and then refinancing it, holding it long term, or selling it, renting it up and then selling the asset and the margins on it are great, like 50%. So I could definitely see something like that being very, very useful, because when you're doing development, there's no cash flow, right? Like until the project is pretty much done, like nobody's making any money. And so if you set those expectations with the investors of like, hey, we're going to take this, we're going to park it in this FDIC money market, we're going to pass through whatever interest we get, and we're going to go out and hunt deals, but you're in my next deal. I do think that could be attractive, because my deal filled up in 5 days. There was at least another $500,000 that wanted to come into the deal that couldn't. And I only talked to probably 20% of my investor base, right? So it was the demand was there for that deal. And I mean, knock on wood, it wasn't hard to raise for that, because it was exciting. But also I got to think about my capabilities. It's like, I'm going to be the GC. I'm going to be building this. I'm going to be on site every week or maybe every day. Can I do 10 of those at once? I mean, you do uncover new problems. And like, do I want to be Grant Cardone? Like, I mean, I don't know that I admire the guy. I don't know that I want his life necessarily, but
shoot for the stars, Jennings. Come on.
No,
but do it in your own. I mean, it's your, again, it's going to be on your why. It's your why.
Yeah. Yeah. So, well, cool. Well, Chris, man, I really appreciate you joining me. If people are interested in what you're talking about, obviously you're very knowledgeable with tax strategies and cost segregation, how to protect, high income earners, high net worth individuals. You've got real estate deals going on. You've got opportunity for people. How do they connect with you, Chris?
So that's great. They can reach out to me by giving me a call at 865-978-6746, or they can reach out to me at chris@bluedoorcapitalgroup.com. I'm also on LinkedIn, Facebook, and also Instagram.
I was just going to say that Blue Door Capital Group, you can find them on Instagram, Facebook, LinkedIn, shoot them a DM, shoot them a text, and connect with Chris. But hey, I've enjoyed
My website is bluedoorcapitalgroup.com, and they can actually book and schedule a strategy call with me. I'd be more than happy to help. I'm a firm believer that if you pay it forward, it comes right back to you.
Yeah. And I love a podcast where I'm learning something new. And I learned two things here, the fee simple tax credit. I can dig into that a little further. And then how a billionaire, Cardone, is structuring. We're getting an inside look from an actual LP on one of his funds. And that's intriguing. So I appreciate you sharing with us, Chris. And thanks for being on the show, man.
You betcha. Let me know if I can help.
All right, guys. Thanks for tuning in this week, and make sure you take some time to unlock your life. Peace.